Good morning. Welcome to ANZ News. Wednesday, 14th of July. Midweek madness. Hope everyone out there is surviving. Today we're talking Rick Rule and the triple gold demand. Whilst today we share some excellent insight from Rick Rule, first the important context. Last night saw the third red-hot inflation print out of the US in a row. Against expectations of 0.5%, the US CPI jumped a whopping 0.9%. And that's just for the month of June, nearly double expert expectations. Its highest print since 2008 and up 5.4% from June last year. Let that sink in for a second. Core CPI, excluding food and energy, rose 4.5%, the highest print in 30 years. In the 3 months to June, Core CPI increased more than 8% annualized, the fastest since the early 1980s. Importantly too, this isn't seeing a flow through to wages yet, with inflation-adjusted average hourly earnings falling 1.7% in June after slumping 2.9% a month earlier. Who out there still thinks this inflationary is transitory? Here's some core CPI charts here for you, excluding food and energy, of course. But wow, look at that increase. The market's reaction was very interesting. There seems a slight move away from the transitory belief or narrative. Shares fell, gold rose, and the USD rose. Topically on the dollar, and as a reminder of this market absurdity, let us rephrase that. On the news that the dollar is being devalued at a 3-decade high pace, the dollar price surged. How bizarre is that? The same can be said for shares, which fell on the news that would ordinarily be interpreted as bullish for the economy. But it's not, is it? Rising inflation, if not transitory, will mean rising rates, and the market is burdened by any amount of debt that it simply cannot handle. The Fed will increase monetary stimulus to stop it. And so what of bonds? They whipsawed, but tellingly, we ended up with a higher short-term yield and falling longer term, with the mid-year US Treasury marginally down. However, right at the end of the day, there was a disastrous 30-year UST auction, which dragged all yields up to end the day higher, and the transitory inflation narrative seriously questioned when the rubber hit the road. So why did gold rise? It would be hard to put it better than the legendary Rick Rule, recently retired CEO of Sprott US Holdings, courtesy of a recent interview with Real Vision. This from him. Precious metals, but particularly gold, do well for many reasons. Many reasons having to do with fear, but most specifically the fear of efficacy of the ongoing purchasing power of one's savings in a conventional savings asset, particularly assets denominated in US dollars, the world's reserve currency. This is a bit of an American-centric answer, but the truth is that the dollar is the world's reserve currency, and the US 10-year Treasury is the savings instrument against which all other securities are priced. The reason for concern about purchasing power savings denominated in US dollars are, I believe from my point of view, well-founded. Let's go through them. The first is quantitative easing. If you did it, it would be called counterfeiting. If you decided to print up jacks and use them as specky, you would be put in jail unless you were a congressman. Explaining that there for the US dollar from him, and that we all just can't print money to fix our problems. Popularity or not, quantitative easing is in fact counterfeiting that makes people nervous about the efficacy of the security. Printing more of them with no backing is definitely not a good thing. The second point that's more pernicious, debts and deficit. I pointed out the last time that I was interviewed by Real Vision that the on-balance sheet liabilities of the US government number is now higher at $28 trillion are basically unserviceable. Think about servicing $28 trillion with a budget of $3 trillion a year in deficit. When you're in a hole, you're supposed to stop digging, but we keep digging. The problem, though, is not the balance sheet liabilities, but rather the off-balance sheet liabilities. Off-balance sheet liabilities like entitlements. The net present value of those liabilities, according to the Congressional Budget Office, exceeds $120 trillion. If you combine the on-balance sheet and the off-balance sheet liabilities that we allegedly owe each other, the number comes to $150 trillion, which is just plain unserviceable. That makes people nervous about the purchasing power of savings denominated in US dollars too, both from a crowding up perspective, but more particularly from a credit quality perspective. The third is the most important reason of all, negative real interest rates. My friend Jim Grant, who I believe you have interviewed, describes the US 10-year Treasury as return-free risk. Think about the arithmetic around the US 10-year Treasury. At present, today, I think they pay you 135 basis points, 1.35% in a currency that by their estimation is depreciating by 4.5% each year. That means, for the first time in your young life, your government has told you the truth. If you give them money, they will give you back less. They guarantee it. Negative real and lower nominal interest rates are, from my point of view, the prime reason why we are in a precious metals bull market, and I see them continuing. I don't see that they have the ability to, as an example, pay higher interest rates on the government debt or let higher interest rates permeate through the rest of the economy. I think they're trapped with negative real and low nominal interest rates. But there's one more reason too, and that's precious metals market share. The market share in US markets of precious metals and precious metal securities is about 0.5%. That's the market share of total investment savings, assets, and estate comprised of precious metals and precious metals related assets is a little below 0.5%. The 3-decade mean exceeds 1.5%. Gold doesn't have to win a war against the US dollar. It just needs to lose less badly. It needs to merely revert to the mean. Where precious metals and precious metals related assets return to mean, demand for them in the largest savings and investment market in the world would triple. And that's precisely what we think is going to happen. That's news today. Thanks, Rick Rule, for your commentary there. If you are after the physical stuff, jump over to ainsleyBullion.com.au. You can purchase instantly now. Just click through to the checkout with your goods and we can have them delivered to you. If you're interested in cryptocurrencies, ainsleywealth.com.au and our own crypto, it's called the Gold and Silver Standard. If you haven't checked that out, go and have a little read. It's pretty fantastic stuff. Enjoy your Wednesday, everyone, and we'll catch you tomorrow for more news.